Something big is happening, and it's already hitting your wallet. Since January 2025, the US has launched a massive new wave of tariffs, reshaping the economy, shaking up global trade, and sending prices soaring. This isn't just politics, it's your groceries, your gas bill, your next iPhone, and your investments. This is America's new tariff tsunami. Let's break down what's really going on. So, what exactly is a tariff? Simply put, it's a tax. A tax placed on goods that come from other countries. And when those goods enter the US, that tax doesn't just hit the importer, it often trickles down straight down to you. Why do governments use them? The usual reasons are protecting domestic industries from foreign competition, to reduce trade imbalances, to gain leverage in negotiations, or to respond to unfair practices. But there's always a catch. Tariffs can backfire. They can push prices higher at the store, trigger retaliation from other countries, wreck global supply chains, and rattle financial markets. Now that we've covered the basics, let's look at how the 2025 tariffs rolled out and why the entire world is watching. The current wave of tariffs began immediately after President Trump's inauguration. On January 20th, 2025, President Trump signed an executive order instructing his cabinet secretaries to develop comprehensive reports on trade practices and recommendations for tariffs. This wasn't just symbolic, it signaled immediate action on one of Trump's key campaign promises to reshape American trade policy. Only 12 days later, on February 1st, Trump announced significant tariffs: 25% tariffs on goods from Canada and Mexico, America's closest neighbors and largest trading partners, 10% tariffs on Chinese imports, targeting America's primary economic rival. The administration cited national security concerns related to immigration and drug trafficking as justification, particularly for Canada and Mexico tariffs. The Chinese tariffs took effect almost immediately. On February 4th, Beijing responded swiftly, implementing retaliatory tariffs on American goods, making a significant escalation in trade tensions between the world's two largest economies. The tariffs on Canada and Mexico were initially suspended for 30 days, but on March 4th, they officially took effect. On the same day, President Trump doubled down on China, increasing tariffs from 10% to 20%. This brings us to present day.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that.
On April 2nd, tariffs were imposed, causing the market to plummet by historic margins. Just a few days later, on April 9th, the Trump administration announced an extension delaying the tariffs for 90 days, bringing green back to the market. So what does this wave of tariffs mean for everyday Americans? The effects are already being felt across the economy, and economists project they'll become more pronounced in the coming months. According to analysis from the Atlanta Federal Reserve, these additional tariffs could raise consumer prices on everyday retail purchases by 0.81% to 1.63%. While that might not sound dramatic, it represents a significant increase across all categories of consumer spending. Let's break down how this affects your daily life. First, food and beverages. Many Americans don't realize how much of our food supply is imported, from fresh produce in winter months to specialty items year-round. Imported food makes up a significant portion of what we consume. Higher tariffs mean higher grocery bills. Second, electronics and appliances. Many components for devices like smartphones, laptops, and household appliances come from China, or are assembled there. Any tariff on Chinese goods directly impacts these items. Third, clothing and footwear. The global supply chain for textiles and finished garments means higher tariffs translate to higher prices at retail stores across America. Fourth, automobile parts. With steel and aluminum tariffs affecting manufacturers worldwide, and specific tariffs on Canadian and Mexican imports, both new cars and replacement parts face upward price measures. Beyond just price increases, these tariffs create several broader effects. Reduced purchasing power. Higher prices mean each dollar buy less, effectively reducing real wages for Americans. Limited product choices. When foreign goods become too expensive to import profitably, retailers may stop carrying them altogether, leaving consumers with fewer options. Supply chain disruptions. As companies scramble to adapt to new tariff structures, temporary shortages of certain products may occur. Higher cost of living. These combined effects lead to an overall higher cost of living, particularly challenging for households and other fixed or limited incomes. It's no wonder the US consumer sentiment has plunged to nearly 2.5-year low, with inflation expectations soaring, mainly due to concerns about these tariffs. On Wall Street, the reaction to these tariffs has been pronounced. Markets hate uncertainty, and the rapid implementation of these tariffs has introduced significant unpredictability into the economic outlook. The Federal Reserve, which closely monitors economic indicators, has significantly adjusted its projections. The Fed now predicts that the nation's gross domestic product will grow at just 1.7% this year, a sharp decline from the 2.8% growth we saw in 2024. This slowdown reflects concerns about several factors: inflation pressure. Tariffs act as a tax on imports, raising prices throughout the economy and potentially triggering broader inflation. Reduced trade volume. Higher costs for international trade typically results in less overall trade, potentially reducing economic activity. Retaliatory measures. As we've seen with China, trading partners often respond with their own tariffs on American exports, hurting US businesses that sell internationally. Investment uncertainty. When businesses can't predict future costs or market access, they often delay investments in new facilities, equipment, or hiring. Market analysis expect trading to remain volatile in the near term, with the expanded tariffs looming as a key catalyst for potential market movement. Despite the challenges, not all corners of the economy are taking a hit from these tariffs. In fact, some companies are positioned to benefit from reduced foreign competition and shifting market dynamics. Domestic steel and aluminum producers are clear winners. With 25% tariffs on foreign metals, US companies like Nucor and UE enjoy pricing advantages that boost their competitive edge in the domestic market. In the energy space, EOG Resources continues to stand strong. With low reliance on imports and favorable regulatory tailwinds focused on energy independence, the company is better insulated from trade-related disruptions. Tobacco giant Altria Group faces minimal impact due to existing high tariffs protecting the US market and the nature of its primarily domestic customer base. For domestic alcohol production, Constellation Brands, STZ, maker of Corona and Modelo, produced in Mexico but distributed and marketed from the US, could see a competitive lift as higher tariffs push up the price of imported rivals. Finally, in tech, CrowdStrike stands out in the cybersecurity field. With a software-driven, service-based model, the company is largely untouched by tariffs and benefits from increased demand or domestic digital protection. As we navigate the significant shift in American trade policy, both consumers and businesses face a period of adjustment and uncertainty. The full economic impact of these tariffs will take months to fully materialize as markets adapt and trading patterns respond. If this is how the next trade war starts, imagine what comes next. Subscribe so you're not left behind. I'm Audit Trades with DIY Wall Street. Thanks for watching.